Welcome back. The U.S. Fed is widely expected to make its third interest rate cut of 2024 later today, this afternoon at 2 p.m. Eastern Time, at its last meeting of the year. Our next guest anticipates another 25 basis point rate cut today, but he adds the economic backdrop has significantly changed and the focus will be on economic projections for 2025. Joining me from Washington, D.C. is Blake Gwinn, head of U.S. rate strategy for RBC Capital Markets. Blake, thanks a lot for joining us. So the focus will be on the guidance. What do you expect the Fed and Jerome Powell to signal about the January meeting?
So, to be fair, Powell has been very stingy with forward guidance. I do not expect him to give anything specific, directly kind of setting up any action on January. He's going to want to leave his optionality around that open. I do think that what we see in the SEP dots, so the projection update we will get, is definitely going to see a hawkish shift. If you kind of look at where we were on a data front back at the time of the September meeting, which is when we got the last update to those forecasts, things have significantly improved. I think if you look back in September, we were, coming off some multiple downside surprises on inflation data. Payroll growth was slowing. We were all kind of talking about these QCW, these downward revisions to payroll growth. The SOM rule had triggered on the unemployment rate. So a pretty negative situation. And they obviously responded by cutting 50 basis points, more than most people had been expecting, a month or two prior to that. So if you look at where we're at now, things are on, a pretty solid ground. We had a large GDI revision, which Powell himself has kind of pointed to at the last meeting as the removal of a major downside risk. Payrolls have picked back up. We've seen unemployment rate kind of chopping sideways over the second half. So a much better economic footing for the Fed. And I would expect those forecasts to reflect that.
You expect the Fed to cut on the final day of January. Square that up with us. How does that fit with an improved economic picture in the United States?
Yeah, that is a pushback we get. You kind of lay out this whole case that things have gotten a lot better and how it's going to impact the forecast. The very obvious next question is, then why are they cutting at all at this meeting? I think they probably justify that in terms of kind of what's already been delivered. The progress we've already had on inflation probably justifies, getting to the top end of those neutral ranges. And as you've heard from Powell, he still thinks we're approaching the top end of that neutral range. So there's still implying that there's some cutting that should probably be done. If you kind of look across the comments we received from other Fed officials, you see this kind of recurring theme about caution and moving slowly and being careful. But it's still moving. I don't think you see any of them saying, well, we're at neutral, time to stop, we're done cutting. But really talking about caution, proceeding more slowly, being very careful as we reach the likely end of this cutting cycle. So that's why we have them cutting in December. We have them cutting in January. We have the pause essentially starting in March.
We get the dot plots later today, correct? And what do you expect to see in the dot plots? Do you expect to see a forecast of fewer rate cuts in 2025?
Indeed. I mean, as I discussed before, I think it's, we're obviously going to see some upgrades to the economic forecast. And I think hand in hand with that, we should see some, improvements in the rate forecast as well. I think market consensus is probably that they move that 2025 median, that goes up by 25 basis points. We think that's actually understating a little bit how much things have improved. So we have that moving up 50 basis points, which would only imply, 2 25 basis point cuts in 2025. This would be, much closer with what markets are pricing. Even though the consensus seems to be for that 25 basis point increase rather than 50, that's probably more aligned with where markets are currently pricing at this point. If you look at that kind of, what's being priced for basically year end of 2025, we're about 50 basis points wider than where the last update to those dots was in September for 2025. So, that's kind of what we're seeing, more aligned with the pricing rather than kind of the anecdotal consensus that we're hearing across the street.
What's your view on the U.S. dollar, which, as you know, is of keen interest to us here in Canada because the most important exchange rate for us is the Canada-U.S. exchange rate. And we're seeing the Canadian dollar now hit a level that it's only hit twice in the past 20 years. That's sub 70 cents U.S.
Generally our view there is for continued, dollar resilience. I think if you kind of go back to the rate side, we have a growing differential between the two sides of the coin. We have the rates in U.S. remaining relatively hawkish with, as I mentioned, the Fed only cutting twice more, stopping at a terminal rate of 4 to 4.25, whereas, Canada continuing to cut more consistently down to kind of a 3% type of level. So that growing rate differential probably keeps some support there. And then if you do start layering on trade policies that would likely cut deeper in Canada than they do for U.S. growth, we do think that, kind of U.S. exceptionalism, for lack of a better term, that story can continue.